Hello and welcome to O Finance Channel. If you're a homeowner, investor or thinking of buying property in Australia right now, you'll want to stick around. The Reserve Bank of Australia has just held the official cash rate at 3.60%. Despite multiple rate cuts earlier this year, the board has paused and emphasised that the path of easing is now uncertain. Let's first review what the cash rate is and recent changes. The cash rate is the overnight interest rate banks pay to borrow from each other, set by the RBA's Monetary Policy Board. Throughout 2025, the RBA cut the cash rate several times, for example in February, May and August, bringing the rate down to 3.60%. But in November 2025, the board decided not to cut further, holding at 3.60%, and signalling that further moves will be data dependent. Why does this matter? Because the cash rate influences nearly all loan and deposit interest rates, variable rates, savings returns, and ultimately the cost of a home loan. Now let's explore the reasons behind this decision. Firstly, inflation. The RBA has noted that inflation has remained elevated. In its November 2025 statement on monetary policy, the bank pointed to inflation forecasts being higher than expected and core inflation still outside its 2 to 3% target band. Governor Michelle Bullock explicitly said the board did not even consider a rate cut at the November meeting, instead choosing to hold and watch the data. Secondly, the labour market and spending remain tight. Household credit and housing prices have picked up further, which adds inflationary pressure. Thirdly, mortgage and repayment burdens are already high. The RBA noted scheduled mortgage payments remain elevated as a share of household disposable income. Put together, these factors suggest the RBA is cautious about easing monetary policy too soon. In other words, they're prepared to hold the rate until they're confident inflation is on a sustainable downward path. So what does this mean for you, whether you're paying, refinancing, or buying? For homeowners on variable rates, the immediate implication is that relief from lower interest rates is unlikely in the near term. With the cash rate held, variable loan rates may not drop further, and in some cases could actually rise. For those hoping for a next rate cut, the board has signalled that cuts may be delayed or even omitted if inflation remains above target. Market participants now expect perhaps one cut by mid-26 rather than multiple. For potential home buyers, stability in the cash rate may reduce the chance of cheaper borrowing soon. However, competition among lenders is increasing, which might still offer opportunities in terms of loan features, refinancing incentives, and fixed versus variable rate strategy. For those refinancing, even if the cash rate is stable, individual lender behaviour matters. Some banks may reduce margins, introduce sign-up incentives, or have competitive variable fixed rate offers despite the RBA's stance. The RBA also noted that spreads between bank lending rates and the cash rate are lower than pre-pandemic. Finally, for budget planning. With inflation higher and repayments staying elevated, it's more important than ever to model your repayments under stress test scenarios, build buffers, and review your loan structure. Turning now to the broader property market and investors. House prices and rents. The RBA warns that house prices and rents are expected to rise in 2026. Housing credit growth. The easing of policy earlier in the year has fed into increased housing credit and stronger demand. Investors' margin. With variable loan rates still elevated and fixed rates perhaps more attractive, but with less movement, the investor equation is shifting. Some investors may look at longer-term holds, yield strategies, or alternative asset classes. Supply constraints and affordability. Although borrowing conditions remain favourable compared to some past years, affordability remains challenged due to higher prices, and this is a factor the RBA is watching. So for investors, it's less about expecting a flow of cheap money in the immediate term and more about strategic positioning. Lock in competitive rates if you can, leverage the tax and depreciation benefits where applicable, and keep a close eye on rate spreads, loan features, and property market trends. Given this environment, here are some practical steps you or your clients can take. Review your current loan. Check variable versus fixed rate options, locked-in periods, whether your repayments factor in expected future increases, not just current rates. Build buffers. If your repayments didn't fall and you're on variable, make sure you can service a rate higher than your current one. Lenders typically stress test loans at higher rates. Consider refinancing. Even though the cash rate is stable, individual lenders may offer incentives, lower margins, or better features, especially as competition increases. Don't rely solely on future cuts. Since the RBA is data-driven and cuts may be delayed, don't assume future relief. Plan as if rates stay where they are or rise slightly. Talk to a mortgage broker. A broker, like your business, can assess your full profile, compare lender offers, and ensure you're on the right strategy for your goals and risk tolerance. Keep informed. Monitor upcoming RBA meetings, next on 9th December 25, and key data releases, inflation reports, employment, housing credit. Here's a realistic scenario. Suppose you have a $700,000 variable loan with 20 years remaining. If your current interest rate is 6% and it doesn't change for the next 12 months, your monthly repayment might be around $5,015. But if rates were to increase only 0.5% because inflation stays high and the RBA holds the rate, your repayments could rise to $5,219. That's $204 more per month, or nearly $2,448 per year. On the flip side, if you have locked a fixed rate and are overdue for a renewal, now might be a time to consider locking in a competitive rate before lenders raise margins or increased competition disappears. This illustrates why reviewing your loan now, rather than waiting for a possible cut, is sound strategy. Let's wrap up. The RBA's decision to hold the cash rate at 3.60% is a signal of caution. Inflation remains elevated, the labour market is tight, and the board is data dependent. For borrowers and investors, this means don't count on relief soon, act now to assess, position, and protect your financial future. If you'd like some personalised help, whether it's reviewing your home loan, refinancing, or planning your next investment, our team at O Finance is here to provide a tailor-made solution. Thanks for watching. If you found this video helpful, please like, share, and subscribe for more up-to-date insights on property, banking, and investing, and practical tips to help you make smarter home and finance decisions. I'll see you in the next one.